Welcome to our first module of our course, Introduction to Web3 and Blockchain. In this module, we will embark on a fascinating journey through the evolution of blockchain technology and its transformative impact on the digital world. As we navigate through this module, you will gain a comprehensive understanding of foundational concepts of blockchain, the innovative potential of Web3, and how these technologies are reshaping industries and societies globally. Before we dive into the course content, allow me to introduce myself. My name is Jamilia Grier, and I will be your guide through this comprehensive journey of Web3 and blockchain. With over 15 years of legal experience, I've had the privilege of working on a number of pioneering projects and collaborating with leading technology and data experts in the industry. My goal is to provide you with a thorough understanding of these technologies, combining theoretical knowledge with practical insights to equip you with the skills needed to navigate and leverage the Web3 ecosystem effectively. This course is tailored for legal and compliance professionals. As I mentioned, my goal is that you understand the theory and you're also able to apply it through practical, real life examples. We will walk through case studies, and hopefully, these examples that are provided will give you additional context so that you can navigate easier in your role. The learning objectives of this course are as follows. First, you should understand the basic concepts and components of Web3 and blockchain technology. We also hope that you'll be able to differentiate between Web 2 and Web 3. By the end of this course, you'll be able to explain key blockchain concepts such as decentralization, smart contracts, and cryptocurrencies. You'll also be able to recognize the value proposition of blockchain for the legal industry. And lastly, you'll be able to identify the legal implications and regulatory challenges associated with blockchain technology. Let's start with the history of blockchain. In 2008, an individual or group under the pseudonym Satoshi Nakamoto published the Bitcoin white paper, marking the inception of blockchain technology. The following year, in 2009, the Bitcoin network was launched, introducing the world to the first decentralized cryptocurrency. This period was characterized by initial regulatory uncertainty as governments and financial institutions grappled with how to classify and regulate this novel asset. Now, for the years 2013 and 2014, there was the publication of the Ethereum white paper, and that white paper proposed a revolutionary platform for decentralized applications using smart contracts. This era also witnessed the establishment of major cryptocurrency exchanges, facilitating easier access to various digital currencies. Now, as a result, regulatory bodies began focusing on things like AML and KYC, which I'm sure you know are anti money laundering and know your customer regulations for these exchanges. Ethereum's launch in 2015 enabled the creation and execution of smart contracts, which are self executing contracts with the terms directly written into code. Now, in 2016, the DAO project aimed to establish a decentralized autonomous organization, but faced a significant hack, raising critical questions about the enforceability and security of smart contracts. At this time, regulators started to express concerns about the legal status and regular oversight of DAOs themselves. During 2017 and 2018, the blockchain ecosystem experienced an explosion of ICOs, and this is a new method of fundraising for blockchain projects. The United States Securities and Exchange Commission issued the DAO report in 2017, signaling that many tokens could be classified as securities. This led to, once again, increased regulatory scrutiny of token sales this time, and heightened oversight to protect investors. The launch of major stablecoins, cryptocurrencies, and others pegged to stable assets like the US dollar occurred between 2018 and 2019. Now, alongside that, there was also the emergence of early decentralized finance protocols, also known as DeFi. These developments prompted more regulatory bodies to focus on the backing of stablecoins and the systemic risks they might pose, as well as the regulatory framework applicable to DeFi. The years 2020 and 2021 marked a boom in the market for non fungible tokens, also known as NFTs. These are unique digital assets representing ownership of specific items. Simultaneously, major companies and financial institutions began adopting cryptocurrencies. They also began highlighting the growing legitimacy of blockchain technology. However, this period also brought to light issues related to copyright and intellectual property in the NFT space. Once again, we also experience increased compliance requirements for institutional players. In 2021 and 2022, Web3 technologies gained mainstream traction with the rise of metaverse projects and the resurgence of DAOs once again. These two items challenged traditional organizational structures. The advancements sparked debate over jurisdiction, governance, and other legal challenges that could happen within virtual worlds. And a whole host of legal questions were raised about the status and regulation of DAOs. From 2022 to 2023, significant progress was made in developing comprehensive regulatory frameworks for cryptocurrencies and Web3 across major jurisdictions. Unfortunately, the United States did not see much of this regulatory framework development. Overseas, this was a period for an increased focus on consumer protection and clear legal standards for crypto assets, enhancing transparency and accountability in the sector. Today, Web3 technologies are increasingly integrating with traditional systems. They've begun fostering continuous innovation in areas like decentralized identity and privacy preserving technologies. The evolving legal frameworks aim to accommodate these hybrid systems with an intensified focus on data privacy and security in the Web3 landscape. Now we're going to get into introduction to blockchain. And I want to paint a very practical idea for you about what blockchain technology is because it's so important that from this point on, you fully understand what blockchain technology is and how it works, even if it's in the very simplest terms. So we talk about blockchain in terms of the fact that it is a decentralized distributed ledger. And we're going to go through what those terms mean, but the main components of it is a record. So that is the ledger, right? And so when we think about a ledger, I want you to think about a list of transactions, similar to a checkbook or similar to any sort of balance sheet. It is simply a shared record of transactions within a network. And what is very interesting about this ledger is that it is decentralized. That means that there is no single point of control. That means that no one person or one entity can change the transactions in this ledger. As such, the ledger is immutable. That means that the data cannot be altered, it cannot be revised once it's recorded. Now, another very important characteristic about a blockchain is that it is transparent. This means essentially that any transaction that happens on a blockchain, if it is a public blockchain, it is transparent for anyone to see. And so you can go to certain websites like Etherscan to see all of the various transactions that are happening on the Ethereum network. And so when we think about blockchain, I want you to remember that all blockchains, public blockchains, because there are private blockchains as well, but all public blockchains must have these characteristics. It has to be a ledger, which is a record of transactions. It has to be decentralized for a public blockchain, meaning that no one person or central authority can control it, thereby enhancing security. It has to be immutable, meaning that once a transaction happens and once it is verified, it cannot be changed. Okay? And it has to be transparent. So these are the main components of blockchain. Now we're going to talk a little bit more about how it actually works. So, and let me just move this over here for a moment. When I think about blockchain, really, I have to go back to the technology that is underlying it. And the way that blockchain actually works is through data and mathematical computations. So I gave you an example, and you can think of something like a checkbook or a financial balance sheet, any sort of financial balance sheet. You can think of an Excel spreadsheet, okay? And in each cell, there is data, right? And that data is confirmed through the blockchain through different things that we call consensus mechanisms. So when you think of the term blockchain, it's just really detailing what I described previously, which is that it's a ledger or a chain, and the blocks are the different pieces of information that are within that. And so how do we verify as we go cell to cell that what happened yesterday is valid and that what happened today is valid, and so on and so forth? And how do we verify if there's no one central source to verify? Well, we use what we call proofs. And proofs are different types of consensus mechanisms. So let's think about proof of work. As different blocks of data are confirmed in the blockchain, proofs of works basically allow for these mathematical computations to be solved by miners. And so we will talk a bit more about this, but a miner's job essentially is to validate a transaction. And that transaction is validated through, here it says puzzles, but they're really mathematical computations. And so what you'll see in the news a lot today is a lot of discussions about how much energy it takes for proof of work protocols to operate and how that energy impacts our ecosystem, our environment, rather. And so there are pros and cons to different consensus mechanisms. The next consensus mechanism I will talk about is proof of stake. So with proof of stake, we don't refer to those people who operate proof of stake. We refer to them as validators rather than miners. And those people are basically staking tokens or holding on to tokens in order to validate transactions. So now you get the full picture that within a blockchain technology is that you have various players who are all incentivized to validate transactions, whether they are mining through proof of work or whether they are validating through proof of stake. Stake, once again, just means to hold on to, in order to validate transactions on the blockchain to make sure that it is immutable, right? To make sure that there are no changes that are being made to the data once a transaction occurs. The third example is a delegated proof of stake. It's very similar to a proof of stake, except instead of me as a validator doing it, I can actually delegate that responsibility to someone else. Now let's talk about nodes. Nodes and transactions. We talked about the blockchain being a ledger or essentially a list of transactions. And what we want to make clear here is that miners are with respect to proof of work and validators are with respect to proof of stake. But all of these are essential for any blockchain to work. And so when we think about being a lawyer or being another non-technical professional working in a blockchain company, it's so important to understand whether that company is operating under a proof of work or a proof of stake protocol. Now let's talk about how the world evolved from Web 2 to Web 3. And we needn't really go back to Web 1, but some of you may recall that Web 1 was the internet where you simply can just read information. You really cannot add to the information, you cannot change it or anything else. An example of Web 1 would be something like a system called Prodigy. Really, when the internet first started, and any information that you could view on the internet was simply for you to read. It was simply for informational purposes, and you couldn't really contribute or create content. Today, we're really in a state where we are between Web 2 and Web 3. Web 2 is, centralized platforms owned by companies such as you have your YouTube and you have Google and you have Facebook. You have many of these large companies. They are centralized platforms, which means all of the information that is contributed on those platforms is owned by those companies. And with Web3, we are moving towards a decentralized footprint where the information that is on decentralized platforms, while those platforms and other pieces may be sort of set up by certain companies, those companies cannot change or they cannot modify the information that's there. And therefore, the idea behind it, and whether or not the business practices this, is a different story. But the idea behind it is that that information is not owned by any one organization. And so this is decentralized internet. You will hear a lot more about something called dApps. dApps are decentralized applications. So if you look at your phone today, whether you go to the Google Play Store or you go to your App Store on your iPhone, you'll see a whole marketplace of apps. And so, what we are moving towards with Web3 is that these apps are actually decentralized and they're not owned by any one individual. And so, why is that interesting? Why is that important for us as we begin to learn about technology in this way? Well, there are so many different business cases, business models that are disrupted with a decentralized application. Business changes, the idea of who the customer is changes, the idea of intellectual property rights changes, the idea of who your market is, who your global footprint is, or your country footprint rather, that changes. All of these things are altered with Web3. We talked about transparency when we talked about one of the key characteristics of the blockchain. And really, transparency here, as we look at things such as dApps or other decentralized platforms, transparency is key to consumer protection. And so, as we move towards discussing how Web3 can be used in different products, when we talk about things like NFTs, cryptocurrencies, decentralized autonomous organizations, I really want you to think about how does that disrupt and change where we are at today? Is there enhanced security? Are there a reduced need for intermediaries? We talked about banking in the history of blockchain. How does the role of banks change as we move towards something which is much less centralized? And how will we as a society operate if there is much more transparency in our financial transactions, in who is creating content and who owns the content, and so on and so forth? So let's talk about smart contracts. And I'm going to move this over here a bit. Hopefully, everyone's eyes are okay. So, the basics of smart contracts and why it is so important to talk about it now before we get into talking about digital assets or tokenization is that you need to understand that smart contracts are similar to automation on a blockchain. A smart contract is essentially a command that tells the blockchain what to do and when. And so smart contracts are self executing, they're automated. Once a smart contract is created, as long as the conditions are met, which are denoted in that smart contract, then the smart contract will execute on its own. It doesn't need human interaction. It doesn't need anything but for the conditions to be met. There are many examples of this. You can look at Ethereum. Okay. You can look at ways that certain NFTs work in terms of when you purchase an NFT, what grants are you given and what rights are afforded to you. So we talked a bit about the technical structure of the code and conditions. I think it's important to note here that smart contracts are simply code. They are not legal documents. Now, there has been a lot of discussion and a lot of development over the past few years about real legal contracts being embedded into the code of a smart contract. That is something that is very unique. It is a hybrid smart contract, but for all intents and purposes, smart contracts by themselves are not legal documents. There are ways, and we will discuss ways in which businesses use smart contracts and use their other regular business processes to make smart contracts somewhat legally enforceable, but a smart contract on its own is not legally enforceable. And I think that is very important to note because as we look at the different regulations, we look at laws, we need to also identify some of the gaps in blockchain technology and some of the opportunities to improve. Blockchain use cases. Move this over here. So we've hinted to some of these as I begin to point out to you some of the opportunities for improvement in blockchain, some of the risks, some of the issues with transparency, which while we all think transparency is a good thing, I also don't think users and owners of digital wallets want the entire public to be able to see what they have purchased and when. And so there's a huge amount of work being done in these different industries, which I've listed on the right here, from financial services. We're seeing banks and digital banks and credit card companies really move towards blockchain in ways that can help them lower costs, reduce risk, and reduce human error. So that's a huge opportunity for the financial services industries. Supply chain management, there's a lot of work being done with the World Economic Forum, with their trade tech initiative on how to leverage blockchain to increase efficiencies in trade from country to country in terms of logistics, clearing customs, payments, and so on and so forth. And you can begin to think about this digital ledger being used in a whole host of cases. And as I mentioned that, I mean, I'm also thinking about the healthcare industry. You go to the doctor. Most people, when they go to the doctor, they have, usually abroad, we have a book, a medical book that you're supposed to take with you. And sometimes these books can be lost. And if your medical book is lost, then maybe your medical history is not recorded properly in the system. So blockchain uses in healthcare and in medical places, that's also a great opportunity to really avail of the tracking and the traceability of things. Intellectual property, for sure. We've seen a lot of use cases with blockchain in NFTs with intellectual property. And we have a whole section devoted to digital assets and tokenization, but for sure, protecting property rights, digital rights rather, and really exploring how we can integrate blockchain into our existing intellectual property rights frameworks is a huge thing. So I want you to, at the end of this, to really just dig into the reading materials. We have a lot of use cases to really help you start to think about contextually that digital ledger, the fact that it is immutable, it is transparent, and it is decentralized, and begin to think about the characteristics as it applies to different contexts in different businesses. And whether you are taking this course as a lawyer or a compliance professional or other non-technical professional, I want you to think about what are the industries where blockchain, if it were used properly, could really disrupt and really create efficiencies for users. So, this course, in terms of the listening piece, is coming to an end, but there's a lot of reading that you need to do. I want you to go ahead and look in the system for the different articles. I believe we have several articles there, and we also have a few assessments. So make sure you complete those, and I'll see you at the next lesson.